Hey Tom, how's it going?
I'm good. I'm very good. Good morning from Australia, Kevin. How are you?
Good, good. Yeah, I'm in Cleveland, Ohio, and it's summertime here, but it's wintertime for you.
It
And
is
we're
indeed, and it's quite cold.
quite cold.
Yes.
Well, yeah, it's here it's nice because we have long days now, but soon we're gonna be flipping. So, that's
Oh well,
that's how it
it's
goes.
like the
But
markets up and down.
there you go, exactly. Well, you know, since we're showing this video to both of our audiences. Some of you may not know me, some of you may not know Tom, so maybe it's worth giving a little introduction of each of us. I'll go first. I'm Kevin Davey. I run a website called KJ Trading Systems, and I've been a trader for about 30 years, probably about the last 15 or so. I was able to leave the aerospace field and go and do it full time. And I also teach a class, and I do some speaking, and I'll get into it, but that's how I met Tom. And so, Tom, I'll turn it over to you.
Kevin, you shouldn't forget that you've been trading world champion before, which is
Well, yeah, I
probably
won
one of your
a
amazing credentials.
trading contest a while back, and finished first place one year and second place two other years, and it was a real
I
money
think
contest. So, yeah, thanks for bringing that up. I appreciate it.
statistically speaking, the p-value of that happening by chance is extremely low. So I just wanted to say that. Anyway, um, yeah, I'm Tom Stark. I'm more of an institutional analyst and trader. I've been around the block for quite a while on systematic trading systems. I haven't got those championship credentials. Nevertheless, I'm working with some large institutions, trading billions of dollars and developing trading systems for them. Yeah, currently I'm working with a large firm in Sydney, doing that. I also run my own consultancy and education company called Triple A Quants. And I've also got a master's in aerospace engineering, by the way. So we have something in common here.
Yeah. And so we met in I think it was 2018 at a Algo Trading conference that was in Melbourne, Australia, and we had never met before. But the really neat thing you mentioned, uh, some of your aerospace background. You used to work for Rolls-Royce,
Correct, yes.
the jet engine manufacturer, and I actually
Hmm.
worked for a company that made fuel pumps for Rolls-Royce engines, among other people. And we were when we first met, we were kind of talking to each other, and we found out that basically way in our past career, our old lives, we were uh, in the same building at the same time at one point. You because you came to Cleveland to visit our
Correct.
facility while I was working there, and we didn't meet, but we came, like that close, and it's just so weird that we didn't meet with our old careers, but then we met with our new careers, and it's really kind of interesting.
It is actually quite amazing. And yeah, and the funny thing was I was actually in working on fuel saving systems for the A380 engine as well. So we were actually pretty close. And
Yeah,
I think yeah, it's fascinating sometimes how these things run in parallel. Yeah, and well, now we met, and
yeah.
I still know Cleveland. I still remember it.
Yeah, and so we both went from a technical field, and then decided, hey, trading was the way to go. And I think
Yes.
probably a lot of people who are going to be watching this also experience that, just where they
Hmm.
have technical backgrounds. I mean, I see a lot of people get into trading who have these kind of science, engineering, medical backgrounds. So it's kind of neat. We both did it, and I think a lot of other people out there are hoping to do it.
Yes, and I get this question all the time, by the way. People from engineering and data science, they ask, oh, how can I, how can I step into this? And my standard answer is, well, I'm not a careers coach, so I can't really give you any advice because you probably had the same experience. It's quite um a roller coaster ride, and it's not there's no straightforward step. a career step along that path at all. So it's really difficult to give advice. It really depends on your personality.
Yeah, yeah, that's absolutely right. And I always, anyone who always, whoever says to me, "Hey, I want to start trading full time," my response is always, "Well, hey, just hit the brakes a little bit, go slow, make sure that's really what you want to do. Do part-time trading,
Mm,
make sure you can actually succeed at least part-time before trying to jump in full-time." Um,
yeah,
because it's a hard gig, definitely
it
hard. And
is.
I mean,
Mm,
being aerospace, a lot of the stuff you were doing was the same as what I was doing. It was flight critical, if parts would fail, if things you were working on weren't didn't come out right, the aircraft could crash kind of thing. Not that it ever happened, but uh,
mm.
there was a lot of uh danger, I guess, to it. And to me, trading is tougher than a lot of that. A lot of the decisions, I don't know if you kind of see the same thing when you compare the two.
I agree because I think the reason for that is it's got a more direct effect. Like what your decisions you make, they're like very instantaneous. And the decisions I made in aerospace, they had a knock-on effect. I mean, I worked in strategic research, so sometimes 10 years down the track, um, which is a lot longer.
Yeah,
And so it feels like you're much more, it's a much more immediate thing. And the other thing is, a lot of people think, oh, it looks kind of glamorous from the outside, but when you're in it, it's probably a bit less glamorous. It's more like painstaking crunching of numbers
yeah,
all day
yeah,
long for weeks on end. So I mean, I love my job. I do. But it's probably less glamorous than it looks from the outside sometimes.
yeah. Especially when you add in like having to live through all the drawdowns that we do, and it's tough. It's tough.
Yeah. Yes, yes, for sure. So what was nice was you had a few questions, and what's interesting, we come from obviously quite different backgrounds. You more from a retail, I'm more from an institutional, and so um, there's always things that we there's different paths that we sometimes go and different stuff we work on, and so you had a few questions
Yeah,
uh, of stuff that I'm quite familiar with, and I thought, why don't we just put on a video and
yeah,
answer them for everyone? I think everyone will get a benefit from it.
yeah. And it's
So
great.
that's why we're here today.
Yeah, because you obviously do a lot of research institutional-wise. I do a lot of research, just smaller scale, just myself with doing, focusing on retail. But I came across a couple things, and I thought, just seems weird. And the big thing is like I'm like, who can I ask? And your name, you know, popped into my mind. I'm like, oh yeah, Dr. Tom. He'll be able to give me a good answer, or at least we'll be able to discuss it. Where so many people out there, especially in the retail world, are just these charlatans who know nothing. I mean,
Mhm,
it's kind of obvious that you see it after a little while, and you're like, this person doesn't know what they're talking to or talking
mhm,
about, and so that's why I like to go to you with these. But so the first thing I've seen, and I saw it once a couple years ago, and I thought, oh, that's kind of weird. And I thought maybe it was just me, maybe it was the way I was analyzing the data. I don't know. And then I saw it again like last month. And what it was people always talk about how in any trading strategy, the more trades, the better. Yeah, you want as many trades as you can because that'll work better going forward. So I'm not just talking about the back test. Obviously you count the number of trades in your back test, but I'm looking to say, hey, what works, the next 3 years out, 2 years out, or whatever. And what I found in two separate studies that were completely different data, was that it was actually fewer number of trades. A lot of times were better than
mhm,
strategies with a lot of trades. And it just kind of threw me because hey, everybody says you gotta have so many trades, more trades the better. And I was finding some that didn't have that many trades, yet they had really great performance going forward, like, in the future. So that was my first question to you, if you had ever seen that type of behavior where less trades actually made better strategies than ones with a lot of trades.
Well, first of all, I mean, it always it's the answer is as always very nuanced, right? And you got to first of all look at the people who say more trades are better. And when you work with someone who offers you a trading strategy and they says, "Oh, you should do this," and they are attached to a broker, they're most likely getting paid for the trade flow. And
Yeah.
so the more trades you do, the more money they make. And that's already like a red flag. Secondly, we've got the commissions and so on. So if you do too many trades, right, obviously, especially in the retail world, you get killed by commissions. And that's definitely also, there's always this sweet spot between just enough trades that your P&L is good enough to overcome the trading costs. But then if you are too slow, obviously you're exposed to more risk. So the idea is always that if your trades are shorter, then you are less exposed to the violence of the markets. You have in some funny way less risk. So that in some sense speaks for more trades. But the real interesting question here is what is a trade anyway? So the way I see it in my sort of institutional trading is I actually don't separate things into trades. For me, all a trade is really just a position size that I hold from one day to the next. When you talk about a trade, is what you say is, well, the position size actually over that period doesn't change. So you get into, I don't know, 50 gold contracts or something like that, and
Hmm.
then this position size 50 just stays constant for a duration. Let's say 10 days, right? So the way I see it is, I've got 10, in a sense, 10 trades, but they always have the same position size, so it doesn't actually change.
Right.
Now, the thing is, when you apply a strategy to a system like that, um, the strategy has a certain profile in terms of how much risk it takes and how much expected profit you have. And some strategies, and this is quite common, as soon as you put on a trade, it usually, oh, well, this is just some sort of unwritten rule. It goes into a drawdown at first, and then it it reverts. There's
Right.
actually there's actually an interesting underlying idea that when you think of all the market participants, and especially nowadays where there's a lot of automated systems going on, someone else will have figured out the the same system that you use and also trades it. Some system or a number of systems will do something very similar.
Uh-huh.
And so initially, your what we call alpha will actually end up in a negative position, and then you get effectively a decay of that alpha. But at the same time, as market participants see, oh, this isn't profitable, they will leave perhaps the trade earlier than you, and then your trade actually becomes profitable. So your expected return actually turns positive. And so that actually speaks for a longer trade duration, if you will. Uh,
Right.
so I hope that wasn't too complicated
No,
and
no, that
it
makes
makes sense to you.
that makes a lot of sense, especially that last point, because I know I hear it from people I work with, and I see it myself that you either start a new strategy or you enter a new trade, and it almost always seems like right away, oh, hey, it's going against me. And
Mm,
because people complain about that, and it's nice to hear that you experience that too, because I've always thought, well, maybe maybe it's just me, maybe I just feel that way, or maybe the market, you start to feel the market's out to get me. Somebody knows what I'm doing, and then immediately that's why I'm going into the red right off the bat. And then I also think, well, maybe it's just me psychologically looking at the bad ones and I forget about the times when it goes up. But I've actually kind of tracked it, and it does seem like, just like you said, it seems like things a lot of times start out against you, and
Mm,
you might, the longer you're in a trade, sometimes the more chance you get to recover. Where
yes.
maybe it's the weaker people who try something that doesn't work and they're like, I'm out of here. Where you tend to stay in, and then you're rewarded for that. But so
Mm,
that's interesting, because I almost started to think, well, it's seeing fewer trades. Well, now you're getting, obviously if you take it down to one trade, you're buy and hold, and which, for the stock market, stock indices might not have been that bad of a thing to do. But I thought, well, maybe there was some of that. And then you had mentioned when we talked, just emailed beforehand, that maybe some of it's the criteria you're looking at. Are you looking at net profit, or are you looking at maybe some kind of risk adjusted return? Maybe those things kind of influence the number of trades too. But it's interesting
yeah.
to see how you do it from a kind of institutional point of view. How you
Mm.
look at it, which is I think different obviously than a retail person might.
It, the risk profile of your trade is actually really important. So when you look at, say, high frequency traders, right, their hit rate, their win rate it's actually really small, right? Like less than 51%. But the law of large numbers kicks in, and so as you actually have this tiny little edge, let's say 50.5% or so winning trades, and you position size them correctly, for example, using something like the Kelly formula, you can see that over time you get this exponential growth in your P&L, and that works because you do a lot of trades. So
Mhm.
you get this small edge. Now the issue is, if you are like your normal retail trader, right? You don't have a technological edge or anything like that. You have an edge that arises from your quote unquote smarts, And
Mhm.
what's interesting is, I told you this before, there is this famous golden rule of portfolio management, or golden rule of active portfolio management, by Grinold and Kahn, that says that your information ratio, which is basically your Sharpe ratio or your risk adjusted return, equals the information coefficient times the square root of breadth. And what that means is that information coefficient is basically the smarts that you have, and the breadth is how many trades you do, how many assets you run, and so on. And let's say there's the two extremes. Let's say a high frequency trading firm, they have an enormous amount of breadth,
Right.
but their smarts are really small. Like, they're not very smart, at least in terms of trading strategy. But let's say Warren Buffett, for the lack of anyone else, he's extremely smart. He does very few trades, so his breadth is really, really small. But he's very smart in the selection that he does, and so he can grow as well. And now, if you're a retail trader trading some systematic strategies, most likely your breadth won't be quite as big, and so your your edge comes from your smarts.
Mhm.
And your smarts may be that you say, well, I enter a trade and I know that there's a lot of other participants that stay in it, that are taking this trade. So initially it might not be so good, but if I stay in it and I wait until everyone else has lost steam and drops out, I can then actually return a profit. And so, I mean, this is not necessarily what you think, but this is often probably what happens subconsciously, and that makes it quite interesting, because that is part of why it seems like less trading actually is more profitable. So what I'm saying is, it's not strictly like that, but given your style and given what you do, it's very possible that this is actually what you observe. If you
Hmm.
were a HFT guy, you probably would observe something totally different.
Yeah. Oh, that's interesting. Where do you think in all that, so you said basically, hey, it's smarts times the number of trades or your breadth. Um, where
Square
do you
root.
think where do you think like diversification how does that fit into it? I'm assuming you're a
Oh,
big fan of diversification.
sure, sure. Yeah, well, breadth is in some sense diversification. So when you talk about breadth, what you say is, well, breadth could be in either so space or time, meaning that you could do a lot of trades in a short succession, or you spread out your trades in terms of how many different contracts you trade or how many different strategies you trade.
Hmm.
Now, there's many ways to diversify, and one way to diversify is, and that's I know that you are big on this, is actually diversify in the strategy space. So you run a lot of different strategies in parallel.
Right.
Now, what's important here is though, diversification only works if you use either assets or strategies that have low correlation with each other. So if you run a lot of strategies and they're all more or less the same, then all that happens is you incur a lot more trading costs at no benefit whatsoever.
Right.
So what you really need to do is you need to make sure that all the strategies you put on have a relatively low correlation with each other in order to contribute to the breadth. And it's actually a really powerful thing if you understand that, because like, let's say just I send you something, just a set of strategies that I looked at a while ago, and each of these the Sharpe ratios are actually pretty low. They're all like 0.6 or so, but when you actually combine them, the whole strategy has a Sharpe ratio of well above 2, which is pretty good for that sort of frequency.
Right.
And it's really just increasing the breadth. It's quite a powerful concept. But you know, you have to obviously see how attainable that is, or how much you can actually do this.
Hmm.
So yeah, I think I'm big on diversification. That's the short answer.
Yeah, well, that's neat. Something else I thought of. One of the things I've noticed. Okay, so we talk about diversification, and yeah, you want low correlation. You look at the returns, and okay, you can come up whatever your criteria is to say these are not very well correlated. Let's say it's two strategies that trade crude oil, and you say,
Hmm.
hey, I look over the last 6 months, year, 2 years, whatever, maybe all of them, and you say, hey, the correlation's really low. Um, I find that's pretty good, but the one thing I've found, and maybe you've found something different or can comment on it, is that's just to me, that's one piece of it. That's the known correlation. I mean, you could
Hmm.
say, yeah, those two strategies, you should be able to trade both of them with crude oil. But what
Yeah.
I always worry about is, and what I've seen in real time is uh, that those strategies, when running real time, could all of a sudden become correlated.
Yep.
And even though historically you're like, oh, well, this one's a mean reversion, this one's a trend follower, they should never really be correlated. And all your numbers bear that out. I find that there's still this hidden, unknown future correlation that could just ruin you. And I
Mm.
know personally, because it's happened to me where there was a time a number of years ago where I was trading uh, a number of stock indices systems, futures systems, where it said, hey, these should not be correlated. And lo and behold, what happened at one point, they all became correlated. And the market fell and I got long signals for all of them, which had never happened.
Hmm.
And of course, then I got out, of course, right at the bottom of the dip, and then I'm left with less money and saying,
Hmm.
what just happened? I mean, have you ever
Yeah,
seen that, or how do you deal with that kind of
absolutely.
aspect?
Absolutely. I mean, this is a very known thing, and some people call it well, there's a few aspects of that, but probably the best known is called tail correlation. So imagine it's always good. I often refer to stocks. I know you trade mostly futures, and
Yep.
me too at the moment. But um, what often happens is you have, let's say, two stocks that are just not that highly correlated. Let's say zero 0.3 in a normal market, and then you suddenly got a market correction. What happens often in corrections is that uh, um, all the assets that are involved in that, which is usually a lot of them, their correlations really go through the roof. So they go all the way to zero 0.9 or even higher. And so when you let's say build a strategy that uh, you on a regular occurrence is just low correlated, but then suddenly you have these events. And so this event could be a correction, but there are other interesting events. You might have heard of the so-called quant quake, where suddenly all quant strategies started to fail. Um, this is almost a black swan in the overall quant community, because a lot of these quantitative strategies are also somewhat similar. And
Mhm.
and what happens is, interestingly, yes, these all the correlations start to really increase to a high level, and you get these, really poor performance overall. And this is something that is important to take into account. The issue is you cannot ever fully understand or take it into account, because if you start taking into account, someone else will, and you end up with a similar effect down the track somewhere. But there's definitely some things you can do, and a well-known one, for example, is people doing what's called tail risk hedging. You may have heard of this. There's a guy called Nassim Taleb.
Right.
He's famous. Um, he wrote the book The Black Swan, and his whole business is based on that, using options contract to basically hedge out that tail risk. So what he says is, well, you accept the risk of the day-to-day operations. We don't care so much. But in the events that all the correlations go towards one, and everything starts to fail, we have you covered. And the way I approach it is really looking at it from basically different levels of risk. You look at the day-to-day risk, what is that? But then also I often look at what could happen on the tails. So when I talk about tails, like you've got the bell curve of
Right.
all the possible events that could happen. And obviously the left side of that, the left side is the one that we're worried about, where we
Right.
have these really big losses, and they are often caused by those high correlations. And so if you really want to be careful, it's worth actually, when you do back tests, to treat these events separately, and actually look what happened specifically during those events with your strategy. And this may not always be apparent in your back tests as much. It may look, you got these nice backtest curves,
Right.
bottom left to top right. And then there's a little dip and you go, oh, this doesn't look like much. But when you're actually in it, it looks a lot amplified. So,
Yep.
so in many cases, it's worth actually digging into this a little bit more, and then wondering, what can happen here? How do I deal with it? What can I do in order to mitigate those issues?
Yeah, that's good. Good point. Yeah, and it's certainly true. I tell people all the time, you can only get so much from looking at that back test. One, it's going to be over optimistic just to begin with, but then two, yeah, those little blips, you'd think, oh, hey, that's no problem, because I think most people see, like you said, the bottom left, the upper right, and they draw a straight line, so they think, oh, hey, I'll make money with this, and they tend to dismiss the little dips, and those are what kill you as far as like psychology, because
Mm,
a little dip could be $5,000 per contract, which it
yeah,
doesn't it is significant to just about everybody who's trading. I mean, I don't know if
For
people
sure.
would say, "Oh, that's nothing," but
When
yeah,
you're in it, it always looks really different than what it looked like on a chart.
yeah,
And I guess only through experience, when you went through these moments, you truly see the full significance of those. There's actually Andreas Klenov. He wrote a book called Following the Trend, and he basically detailed on a year-by-year basis what you would experience as a trend follower. That actually produces one of these beautiful equity curves, but what it would look like when you're actually in the moment. And if you want to know more about the psychology, then I recommend that book. Is really good read in that
yeah.
respect.
I think I've read that, and I know I follow him on Twitter. Well, not Twitter anymore, X, and
Mm,
he's got a lot of cool things to say, and so yeah, that's kind of neat.
yeah, yeah, I like his stuff. He's really good guy.